Hello and welcome to this video on how options trading works in India. Options trading can be a complex topic, but we are going to break it down into simple terms and explain how it works in the Indian context. Part 1. What are options? First, let's start with the basics. Options are contracts that give the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price, known as the strike price, on or before a specified expiration date. In India, options trading is primarily done on two exchanges, the National Stock Exchange, NSE, and the Bombay Stock Exchange, BSE. The most commonly traded options are on individual stocks, although options on indices are also available. Part 2. How do options trading work in India? Options trading works in India in much the same way as in other countries. Investors and traders can use options for a variety of strategies, including hedging, speculation, and income generation. Hedging. One way to use options is for hedging. This means using options to protect against potential losses in an existing position. For example, if you own shares of ABC stock and are worried about a potential market downturn, you could purchase a put option with a strike price below the current stock price to protect against losses. Speculation. Another way to use options is for speculation. This means taking on risk in the hopes of making a profit. For example, if you believe that the price of XYZ stock is going to increase, you could purchase a call option with a strike price below the current stock price. If the stock price goes up, the value of the option will increase, and you could sell the option for a profit. Income generation. Finally, options can be used for income generation. This means selling options to collect the premium, which is the amount the buyer pays for the option. For example, if you sell a call option with a strike price above the current stock price, you collect the premium and keep it as income as long as the stock price stays below the strike price. Part 3. Regulations in India. It's important to note that options trading in India is regulated by the Securities and Exchange Board of India, SEBI. SEBI has established rules and regulations to ensure transparency and fairness in the options market. For example, SEBI requires options contracts to be settled in cash, rather than through the delivery of the underlying asset. This means that if you exercise an options contract, you will receive or pay cash instead of the underlying asset itself. SEBI also imposes position limits on options contracts to prevent any single trader or investor from having too much control over the market. These position limits vary depending on the underlying asset and the expiration date of the option. Conclusion. In conclusion, options trading in India is similar to options trading in other countries. It allows for a variety of strategies, including hedging, speculation, and income generation. However, it's important to understand the regulations and risks involved before getting started. We hope this video has been helpful in explaining the basics of options trading in India. Thank you for watching.